In less than 20 minutes, you'll learn everything you need to know about Forex trading. So what is Forex? Forex is a global marketplace where currencies are traded. It's the largest and most liquid financial market in the world, with trillions of dollars changing hands every single day. Basically, it's a 24-hour market driven by economic, political, and social factors worldwide. Central banks, hedge funds, and individual traders like you and me all participate in this market, buying and selling currencies in the hopes of turning a profit. At its core, Forex trading is all about buying and selling currencies. It's like a global supermarket where instead of groceries, you're trading money. A currency pair is simply two currencies that are traded against each other. It's like a wrestling match between two countries' money, where one currency is trying to gain value against the other. There are three types of currency pairs. First, we have the major ones, which are the most widely traded pairs in the Forex market. They include combinations of the world's strongest and most stable economies. These are the 7 major currency pairs. Next, we have minor currency pairs that don't include the US dollar. They typically involve combinations of the other major currencies. Minor pairs often have less liquidity compared to major pairs. We also have exotic pairs, which involve currencies from emerging or smaller economies paired with a major currency, usually the US dollar. Now, in the Forex market, a currency pair represents the value of one currency relative to another. For example, when you see Euro USD, it means you're trading the Euro against the US dollar. In this pair, the Euro is the base currency and the US dollar is the quote currency. When you buy a currency pair like the Euro dollar, you're expecting the Euro to appreciate while the dollar depreciates. When you sell the currency pair, you're expecting the Euro to depreciate while the dollar appreciates. In the Forex market, every currency pair has two prices, the bid price and the ask price. Let's take the Aussie dollar pair as an example. The price on the left side is called the bid price. This is the price at which you can sell Australian dollars and buy US dollars. The price on the right side is called the ask price. This is the price at which you can buy Australian dollars and sell US dollars. In other words, when you're trading a currency pair, you're always buying one currency and selling another simultaneously. The difference between the bid and ask prices is called the spread. If the bid price is 0.6635 and the ask price is 0.6637, the spread is 2 pips. The spread is essentially the cost of trading, as it represents the difference between the price at which you can buy and sell the currency pair. Spreads can vary depending on the currency pair, market conditions, and the broker you're using. So it's very important to pay attention to the bid and ask prices, as they determine the potential profit or loss of your trades. When you place a buy order, you'll enter the trade at the ask price, and when you place a sell order, you'll enter the trade at the bid price. Now let's talk about two crucial concepts in Forex trading, pips and lots. A pip, which stands for percentage in point or price interest point, is the smallest price increment that a currency pair can move. For most currency pairs, the pip is located at the 4th decimal place. Let's say the Aussie dollar rate moves from 0.6345 to 0.6346. That might not seem like a big deal, but in Forex, that's a 1 pip move. Now, not all currency pairs have their pip at the 4th decimal place. In yen pairs, the pip is at the 2nd decimal place. So for US dollar Japanese yen, a move from 110.45 to 110.46 is a 1 pip move. Pips are essential because they help you measure the distance between your entry and exit points, which ultimately determines your profit or loss. Pips go hand in hand with lots. A lot is a unit of measurement for the size of a trade in the Forex market. There are 4 common lot sizes: standard lot, mini lot, micro lot, and nano lots. The lot size you choose will determine the monetary value of each pip movement in your trade. For instance, If you're trading a standard lot of Euro USD, each pip is worth $10. If you're trading a mini lot, each pip is worth $1. It's crucial to understand the relationship between lot sizes and pip values, as this will help you manage your risk effectively. A larger lot size means that each pip movement will have a more significant impact on your account balance, both positively and negatively. As a beginner, it's generally recommended to start with smaller lot sizes, such as micro or mini lots, to minimize risk while you gain experience. Another important concept related to lots is leverage. Leverage allows you to control larger trade sizes with a smaller account balance. For example, if your broker offers 100 to 1 leverage, you can trade a standard lot, which is $100,000, with just $1,000 in your account. While leverage can amplify your potential profits, it also magnifies your potential losses, so it's essential to use it wisely and in conjunction with proper risk management techniques. So, pips measure the price movements of currency pairs, while lots determine the size of your trades and the monetary value of each pip. Now, let's say you want to make a trade. There are several types of orders in Forex trading. A market order is the simplest and most common type of order. When you place a market order, you're instructing your broker to execute a trade immediately at the best available price. If you're buying, the trade will be executed at the current ask price, and if you're selling, it will be executed at the current bid price. A limit order allows you to specify the exact price at which you want to buy or sell a currency pair. When you place a buy limit order, the trade will only be executed if the ask price reaches or drops below your specified price. Conversely, when you place a sell limit order, the trade will only be executed if the bid price reaches or rises above your specified price. A stop order, also known as a stop-loss order, is designed to limit your potential losses or protect your profits. When you place a stop order, you specify a price at which the trade will be closed if the market moves against you. For example, if you're buying Euro USD and place a stop-loss order 50 pips below your entry price, the trade will automatically be closed if the bid price falls 50 pips below your entry, limiting your loss to that amount. A take-profit order is used to automatically close a trade once it reaches a specific level of profit. For example, if you're buying Euro USD and set a take-profit order 100 pips above your entry price, the trade will close when the bid price reaches that level, locking in your profit. One of the most crucial components is choosing the right broker. A broker is a firm that offers access to the Forex market. They act as intermediaries between you and the interbank market, where the big boys, banks and large financial institutions trade currencies. A broker provides the platform, the tools, and the infrastructure you need to trade currencies from your own home. Now here's the key thing to remember. Not all brokers are created equal. Some are more reliable, transparent, and user-friendly than others. It's essential to choose a reputable broker that is regulated by a respected authority and has a proven track record of serving traders. In order to place your trades, brokers offer you a trading platform. This is the interface between you and the market, where you can analyze price movements, place trades, and manage your positions. Two of the most popular options are MetaTrader and TradingView. Now, how do you anticipate which direction a currency pair might go? Well, technical analysis is the answer. At its core, technical analysis is based on the idea that history tends to repeat itself. You study what happened in the past to anticipate where the currency pair will move in the future. In a trading platform, all the action happens on the charts. Charts are a visual representation of price movements over time, allowing you to analyze historical data. Candlestick charts are the most popular way to visualize past price movements. So what exactly is a candlestick? It's a single bar that represents the price movement of a currency pair during a specific time frame, like 5 minutes, 1 hour, or 1 day. Each candlestick has a body and 2 wicks, sticking out from the